Welcome back. Let's straight away get to an important corporate conversation from the technology space. Now, yesterday I had a chat with Mphasis MD and CEO Nitin Rakesh, and we discussed a lot of things, right? About the long-term tailwinds for the tech sector, the near-term headwinds, what their M&A plans are, and how their business plans have also changed, keeping in step with the uncertain macro environment. But the first question that I began the discussion with are the near-term headwinds and which are the pockets that the company is seeing currently, which are the current pockets of stress for the company right now. Listen in to a slice of that conversation.
There are pockets of higher stress versus lower stress, things that are more linked to global trade, e-commerce, because they're normalizing, the big boom in tech that happened post-COVID. Those are a little bit, I would say, more susceptible to slow down. And of course, within financial services and banking, if you have a very strong capital market orientation, IPOs, issuances, bond issuances, M&A activity is down. So I think those are probably a little bit more, I would say, hit by the immediate impact. Mortgage is another one because, when you have such a sharp spike in interest rates in such a short period of time, it destroys a lot of demand for new loans and refinance loans. But at the same time, housing prices are pretty good. So, you have the tailwind on the home equity side. So it's a little bit of a mixed bag. I think airlines were really stressed early on in the pandemic, really on a big recovery tear right now. But in general, I would say there are segments within banking that are very strong as well. Payments, credit cards, consumer banking, wealth management, asset management, still doing fairly well. So I think if you have a broad portfolio across multiple sectors, even within the U.S., outside of the U.S., you will see these pockets of stress. But I think, as you mentioned, the structural tailwinds of digital transformation, cloud adoption, data engineering and modernization, data platforms, cybersecurity, and in general, anything that takes cost out of legacies is actually very, very well.
So let me just pick on the points about the sectors which are under stress. E-commerce, tech is slowing down. In banking and financial services, the mortgage bit as well as the part which is exposed to capital markets, right? These are the four that you outlined. What percentage of your portfolio would be exposed to this?
That's very, very difficult to
broad range.
It's 50% of our business is banking. Within that, a small percentage comes from, for example, right? So we're talking about a low to mid-single digit exposure to that segment.
Okay.
Now, does it mean that it doesn't hurt? Of course it does, because in the end, if even a small part of a business doesn't grow or declines, that pulls the overall growth down. So I think, but from a focus perspective, 67% of our revenue is application-centric, which is fairly very healthy. Grew even in the current environment, it grew 35% in the last quarter. So I think that's really what I meant about the tailwind from digital transformation driving that kind of growth.
But just coming back to the sectors which are headwinded, would you say about 5 to 10% of your portfolio, your client base, revenue base would be a little stressed?
Probably in that range.
5 to 10%. What about Q3? Are the furloughs going to be higher than what we've seen historically?
I think two things have happened this year. Firstly, the furlough started a little bit sooner. We had a couple of situations in Q2 as well where clients came back and said they ran into budget issues, business hasn't kept up, so they need to kind of reduce expenses. Some of that was obviously not baked into anybody's calculations. Second, on a YOY basis, this time last year was a very different environment, right? The impact of furlough was actually more muted because the mindset of people was, I want to hold on to this talent, I want to minimize the impact of furlough to this talent pool, because if I put them on a long furlough, I may not actually get them back when it comes back to January. This year, the environment is a little bit different. So I think there will be, on a YOY basis, you will see an expanded impact across the industry, not just for us this year. However, I think there are things we can do to minimize that impact, and we'll probably get a better idea in the next couple of weeks. But my sense is, on a YOY basis, this will look a little bit harsher. But also because the impact started a little bit sooner, you may not actually have to see all that impact in quarter in Q3 as well.
So on the whole, it's more, but it's just spread between Q2 and Q3.
Some of it is spread, and on the whole, compared to last year, it'll
be a lot more. Okay. How are your business plans changing? You had plans to double down on healthcare, logistics, expand in Europe.
Yep.
So given the environment that we are in, the uncertain environment, how are you changing your business plans?
See, our reflection is business is a reflection of our client's business.
Yeah.
If they are doing relentless prioritization of their spends, we have to do the same.
Correct.
As such, we haven't really pulled back on any of the growth initiatives. We are still a very growth-oriented, growth above all else mindset. We will continue to invest where we think there's great opportunity for wallet share gains or new expansion. And I think you talked about healthcare. Absolutely the right place to be. Within logistics and transportation, we've continued to invest. We've actually expanded our travel portfolio, airlines included. Within banking itself, we have a whole set of customers that we never did business with, but they're large tier 1 BFS names in the US, so they are expanding Europe as well. We've also doubled down on making sure that within other segments that we already are present in, for example, insurance.